Okay, now we move on to our next topic, which is audit evidence and audit procedures. So basically, we have to know what is the audit evidence and what is the audit procedures. So this chapter is going to cover the following topics. Number one is nature and sources of audit evidence, and then the persuasiveness of the evidence, and then the type or the technique of the audit evidence and audit procedures, and the last one is the type of audit test. Alright, now we move on to the audit evidence. So what is actually the audit evidence? So audit evidence is actually the information that is going to be used by the auditor in arriving their conclusion on the audit opinion. So, or in other thing, is actually is used by the auditor to ensure or to determine the validity of the management assertion. So it means that here, do you really confidence with the information that provided by the management? In order, you would like to come up with your own opinion whether the financial statement give true and fair view. So the sources of audit evidence, it could be number one, obtained directly from the auditor. It means that you do yourself in order to find the evidence. And the second one is from the management. So what are the management that provide you? And it also come from the third party. Third party, it means that the person outside from the company that you are audit. Alright, now we move on. Alright, next one. Okay, sources of the audit evidence. So audit evidence here, we can see like number one is the auditor originated evidence. So auditor originated evidence, it is the highest quality and the more reliable. Why is the highest quality? Because you as the auditor, you do it by yourself. For examples, like analytical review of the company's account. So you do the analysis, and then the observation of the accounting system. So it means that you do observe by yourself on the system, on the internal control, how is actually the system of the company, and then you do your own inspection of the company's asset, whether the asset is exist or not exist. And you do your arithmetical checking of the client's record. So it means that here you do your own calculation, all right, to check whether is it accurate or not. All right, number two is actually evidence created by the third party. So it means that the person who create the evidence is actually the person or the company outside of the company that you are audit. Alright, so evidence obtained from independent sources outside of the company is more reliable. Why more reliable? It's not the company that you audit, it's outside from the company. So they have no intention to make it the false information. For example, here is like a bank letter, or it means that the confirmation you get from the bank, the debtor circulation, or the debtors that have owned to the business, and then purchase invoices. So it means that this one come from the creditors, and then the price list, because as I mentioned earlier, so this kind of the third party, they have no interest in give the false information. Alright, next one is evidence created by the management of the client. So this one you have to be very careful, because the written evidence, if we compare the evidence from the company and outside of the company, of course we prefer the third party. But if the evidence come from the management itself of our client, so we have to look whether this is the written evidence or this is the oral evidence. So which one is more reliable? Of course, the written evidence is more reliable compared with the oral evidence. For example, letter of representation or representation letter. So who is actually made this paper? This letter is management. Alright, so they prepared this letter for the purpose of the material decision that is made in the financial statement. So it means that here anything related with the huge amount that you are encouraged to the client. So they give you explanation in writing. So it means that you are going to be more confident what they are doing. Okay, now we move on to the next. Alright, okay, here the persuasiveness of the evidence. So it means that here what type of the evidence that can give the confidence, or you are more believe in this kind of evidence. Alright, number one is actually it should be relevant. So it means that here relevant to you, relevant to the audit objective, and so on. So here, measure of the quality of the audit evidence. Number one is appropriateness and suitability of the evidence to the audit objective that the auditor is testing. For example, here to test the sales transaction. Alright, in order to test the sales transaction, so what type of document that is relevant to the sales? Alright, it should be sales. Number one, it should be refers to what? For example, such as an invoices. Alright, so here it refers to the invoices. Alright, number two is reliability, whether it can be relied or cannot be relied. So it depends here. Here, degree of evidence can be considered believable or reliable or trust. It depends on the persons of the who provide the information. Number one, by the third party. So it means that information that you do yourselves is better. You as the auditor, of course, you trust yourself while doing your job, and that you have the information from the client or by the third party. Of course, from the third party. Why third party? Because they don't have the interest to give the false information compared with the client itself, right? For example, here they give the example of the bank statement and cash book, and of course the bank statement is come from the third party, which is bank, and the cash book is actually prepared by our client. So which one that you would like to rely on more? It should be more on the bank statement rather than the cash book. Alright, so number three is the sufficiency. Is it enough or not enough for you to come out with the opinion? Alright, so it means that refers to the quantity of the evidence. For example, the sample selected to test, whether is it adequate, is it enough, or is it enough to achieve your audit objective in order to come up with your opinion. Alright, number four is we continue with timeliness. Alright, here it refers to the timing of the audit evidence. Alright, so it refers, for example here, the period covered by the audit. For example, evidence for statement of financial position is more persuasive if it is closer to the balance sheet date. Alright, so this is statement of financial position. So it means that is more reliable because at the due date is better at the balance sheet date. But for the statement of profit or loss, it should be cover the entire period of the audit from the beginning till the end. But for the statement of financial position, so it's better to have the closer date to the balance sheet date. Alright, so here auditors normally rely on the historical data. Alright, so the information should be rather persuasive or influence you to make a decision rather than definite answer. Okay, so this is, we can see that it's only for the persuasive. It normally the information is not be a conclusive. So it means that when you see some of the evidence, it cannot give you a conclusion straight away. The nature of audit evidence are persuasive. So persuasive means that influential, and then convincing rather than conclusive. Alright, so why? Because of this reason. Number one, because of the time and cost constraint. Why? Because the auditor are use sampling only. Because the auditor do not check all of the evidence, they just use sample. Number two, the auditors are not there at the event of unfold event. Alright, and then so here the evidence are not perfectly reliable because during the transaction the auditor is not there. Alright, the third one, maybe the client personnel had left the company, so it's taken over, the job or duty is being taken over by the another person. So this is the evidence. Why is it persuasive? Alright, convincing rather than conclusive. Alright. Alright, now we move on to next slide. Characteristic of the reliable information. So now we would like to see what the characteristic to make sure that information is reliable. Number one, we can see the independence of the provider. As you can see here, the external evidence or the evidence that come up from outside of the business that we audit is actually more reliable. For example, confirmation from the bank. So it means that come from the third party, and the information come from the debtor or the creditor or other third parties is actually more reliable compared with the client or the company that we audit. Number two is actually the effectiveness of the client's internal control. So it means that if the control system of the company is good, so it means that here the evidence that we can get if the client company is good, so it is more reliable. Okay, low detection risk. Why low detection risk? Because when the information is good or the internal control is good, so it means that we can rely on the system of the company. For example, here the existence of the segregation of the duties. For example, they segregate the person who received the money is actually not the person who authorized for the money. So it means that if the two separation of the duties or segregation of duties, so it means that you can trust on the system rather than both are doing by the same person, so it means that easy for them to manipulate for the transaction. Right, next one will be the auditor's direct knowledge. So it means that if the information is obtained directly by the auditor, for example, you do your physical examination and then you do your own observation, you calculate by your own, you inspect by your own, is actually more reliable than you obtain the information from your client. And then the next one is the qualification of the information that you get from which individual. Alright, so it means that refers to the individuals who provide the information. So it depends who is the person who provide the information, whether it has the authority or not has the authority. So we have to look this one also. Okay, alright, next one we move on to we continue on the reliable information. Alright, so documented evidence. So it means that the written evidence is actually more reliable rather than oral representation. So example here, confirmation from a debtor, written confirmation here is actually more reliable than a telephone confirmation. So the written documentation is better compared with the oral. Alright, next one is the degree of objectivity. So it means that an evidence is considered objective if different auditors who examine the same evidence reach the similar conclusion. So it doesn't matter who did this one, so if they would like to reach the same conclusion, so that one is better. So objective evidence is actually more reliable than the audit evidence that require considerable judgment. For example, if we do physical inspection, we can know, alright, okay, that one can meet our existence, the objective of the existence, alright. So you go and see, and you know that the objective is the asset is exists. Alright, next one is the evidence of the form of document or written representation is considered more reliable. Alright, okay, just like we discussed earlier. Alright, for example here, depreciation versus provision for doubtful debt or allowance for doubtful debt. So it means that here depreciation is actually more objective. compared with the policy based on the accounting policy. For example, they are using straight line method or reducing balance method, right? Compared with the provision for doubtful debt. So this is made on the judgment. For example, the company would like to say they would like to provide for the provision for doubtful debt is 10%. So the 10% is actually made from the management judgment. Okay, so now we move on to the next one. Okay, according to ISA 500, so the following procedures in order to obtain the audit evidence. So this is the procedures that you have to do in order to get for the audit evidence. Number one is physical examination. So you check by your own. So this is based on the documentation that you check. This is one based on what you observe or observation. So this is you get the confirmation, all right? And then this is you increase to the client. And then this is the mechanical accuracy. So it means that you recalculate. And this is the analytical procedure. So the details we are going to discuss after this on the next slide. Okay, here. All right. Now, type of the audit evidence or audit procedure. So what is actually audit procedure? So this is the procedure or the auditor that has to do, or the details, instruction or step taken by the auditor in order to accumulate the 7 types of the audit evidence in order to to identify, to determine the specific audit objective. Right, like what we said just now, we have the audit procedures here. So these audit procedures in order to identify for the audit objective. Alright, for example, the audit procedures, for example, we are going to examine, we are going to scan, read, compute, recompute, put, trace, compare, count, observe, inquire, and vouch. Alright, according to ASA 500.5, ISA 500.5, so defines the audit evidence as the all of the information used by the auditor in arriving the conclusion on which audit opinion is based. So it means that this is the procedures that the auditor has to do in order to get the evidence. All right, in order to come up with the conclusion before they come up with the audit opinion. All right, now we move on to the audit evidence and audit procedures. All right, so what are the things that you can do? Number one is a physical examination. Physical examination means that the inspection you do by your own on the tangible asset. Tangible asset, that the asset that you are able to see, you are able to touch, and it has the physical existence. So here the inspection here, whether you go and inspect, you count the tangible asset. For example, here you go and do the stock take, alright? So eventually you go and see whether the asset it exists or not exists. For example, count the petty cash. So it means that you count by your own, right? And then you verify the amount of the closing stock. So this is the audit procedures. You do the physical checking. Alright, next one will be the observation. Alright, observation is actually you do not checking, but you observe. You only go and see or observe what the things being done by the client. Right, so the use of sense to evaluate the certain activities, right, means that you go and see and then you try to evaluate. So usually used by the auditor during the study, it evaluates the client's internal control system. For example, you have to do is observe the handling of cash, but this one you do not do the physical checking, but you go and see how the things being carried out by the client. So you're going to observe next one whether the storeroom are locked for the valuable items, all right, whether they normally do a certain internal controls that they normally stated in their procedures. Right, now we move on to the next one, confirmation. Alright, so confirmation here is actually we already discussed a little bit before. So what is confirmation from a third party? So it's actually confirmation. It means that you get the written or oral response from the independent third party. So it means that the person who outside from the business, to ensure the accuracy of the information. For example, confirmation client's cash with the bank, all right, and then confirmation account receivable balances, right. So this is audit procedure. So it means that here you get the confirmation from the bank. For example, is that right, the company has this kind of amount in your bank, and then whether this company and whether whether you have this kind of money from the, for example, for the account receivable, to make sure that whether this kind of adapters to the client that we audit have this kind of amount account balances. Right, so for the confirmation we have positive and negative confirmation. So positive confirmation, so it means that here they need to respond regardless whether the amount is true or not true. So this is what we call positive confirmation. They will give the feedback whether the amount stated is right or wrong. They still will give the feedback. For the negative confirmation, so the third party is only reply if they are disagree for after a certain period. If the information, for example, they did not receive any response, so they keep it silent, so it shows that the information is correct. So we have the positive and negative confirmation. Alright, now we move on to the inquiries. So what is inquiry? So it means that you're going to inquire. Alright, inquire, it means that it could be written and it could be oral from the client. So for example, inquire with the management whether there are other obsolete stocks or collectability or account receivable balances. So this is the audit procedure. So procedure means that what are the details from details step-by-step taken that this auditor should do. So inquire means that you can ask the client. You can ask in written and you can ask orally. Right, next one we are going to checking or recalculate or re-performance. So it means that in order to check the arithmetical accuracy, so you do your own computation. Alright, and then for example, you do your own computation and then you are checking by yourself whether the transfers made by the client during the period is correct. For example, all the sales that you receive the money, is it exactly transferred the same figure to your account? Or for example, if you purchase something from your client, to make sure that all those invoices that they key into the computer is actually the exact figure that you get from the invoices. For example, here check the calculation of depreciation expenses. For example, the depreciation expenses is 10%. So you have to check whether the 10% is right. Alright. For example, you have to recompute the invoices amount that you charge to the client. For example, the company is making sales to the company A, so you have to recheck the invoices whether the total amount is right and then whether the charge the client is the same amount. Okay, so this is for the recalculate. Alright, now we move on to the next one, analytical procedures. So what is the analytical procedures? So analytical procedures is actually you make a comparison, you make an analysis. Alright, you relationship to determine something, whether A over C, A, C, B, C, and other appear reasonable. For example, let's say you are auditing in the servicing company. So if the profit margin, for example, more than 100%, so that one is normal. But if you are auditing a manufacturing company, so their profit is 120%, some sort like they might come to your opinion what is actually not follow that the supposed the profit margin of the company. So example here, evaluate the reasonableness of the receivables by calculating and comparing ratio, compare the expenses percentage of the net sales. As we know, the service company normally the profit margin is actually high compared with the manufacturing company. Okay, now we move on to the next one here. Alright, documentation. Alright, so what is documentation? So documentation is actually the audit evidence. So how to check for the documentation? So examinations on the client's document record to substantiate that the information should be included in the financial statement. Alright, for example here, a sample of 10 suppliers invoices. So it means that you check the invoices, 10 supplier invoices. So this is the audit procedures. Alright, so what is the audit evidence? Examination on the documentation. Okay, so here inspecting, so you can inspect on the documents. Alright, you can tracing. So what is actually tracing? Direction of testing in the case of form of the source document to the journal. So tracing, so you come out from the source document, you are going to trace to the journal whether the figure is right, whether from the source document is it exists in the ledger. So vouching, so what is vouching? Direction of testing from the journals back to the source document. So here you start with the journal and then you trace back. Is there any source document that exists in the ledger or journal? So this is the tracing, means that from source document to the ledger, and this is for the vouching from the ledger to the source document, the other way around. Alright, now we move on to the next one. So two categories of the documentation or document. Alright, number one is internal, number two is the external documentation. Internal document, it means that inside of the business. Alright, document prepared, used in the within the organization, and then going out to the outside parties, such as customers or vendors. So it means that here, this is the document that prepared internally or prepared by the client company that we audit. For example, punch card, sales invoice, sales invoice that we prepared. Okay, we make sales to the debtors, and then copy of the office receipt. So it means that if you receive the money, you prepare the receipt and then you give to your customer. And then internal report and purchase requisition. So this is the company that they prepare themselves. Alright, so what is the external documentation? So this is originated by the outside. Okay, so the person who prepared this one is outside from the business. For example, supplier's invoice. For example, the company that you audit, they purchase something, so the third party gives them the invoices. Alright, so this is what we call external documentation. For example, bank statement, which is come from the bank, a validated deposit slip, or deposit slip come from the bank or whatever. So it means that this kind of document is actually prepared by the outsiders. So external documentation is actually more reliable than the internal document. Alright, why? Because external documentation, it has in the hand of both the client and the external party. So it means that here for the external documentation, they're not prepared by the client but from the external party, thus indicating that both parties are in agreement about the information stated in the document. So it means that the client and the third party are agreed with the figures. Right, now we move on to the next slide. Alright, okay, here reliability of the audit evidence. So this is the summarization. So as we can see here, so the physical examination is actually due by the auditor itself. So so this is the independence of the provider, of course very high. Do you do yourself? So effectiveness of the client internal control, it depends. Alright, depends on the client whether good or bad. And then auditor's direct knowledge is also high. Why? Because you do by yourself. And then qualification of the information provider, of course you trust yourself, you are the qualified person. And objectivity of the evidence, of course high. Alright, confirmation, so of course high, we get the confirmation. Alright, so this one is not available. Alright, and then auditor's direct knowledge, right, is low. Why? Because it's outside of your knowledge. And then qualifications of the informations of the provider, of course high, usually high because the third party. And the objective of the evidence is also high. Or about the documentation, so it depends. If external, yes. Is the internal, less. Alright, so this one is varies, depends on the internal control system of the company. And then the auditor's direct knowledge is low. Why? You get from the third party. Qualifications of the provider, it varies. Okay, it depends on who prepared the document. And then the objectivity is high. Observation, of course high, you do it by yourself. This one varies, depends on the nature of the business. And then this is high, by your own. And then quality of the information, of course high, you do by your own. And then objectivity of the evidence is medium. Alright, and then inquiries of client. Alright, for the client itself. Alright, it's not the third party, the client that we audit. So this is low. Effectiveness, not available. Auditor's direct knowledge is low because it depends on the client. Qualifications of the provider is varies, depends on the person who has the authority. And then objectivity of the evidence is also varies. And then re-performance, so it means that the audit do by yourself. Alright, this is high. Okay, and then it is varies, depends on the client internal control. And then the auditor's direct knowledge, of course high, you do by yourself. And then this is high, you do by yourself, you have to trust yourself. Alright, so this is audit procedures. Alright, so we continue to the next one. Okay, so this one, reliability of the documentary evidence. Alright, so which one is more reliable compared with the least reliable? So which one is the most reliable? Which is externally document. Alright, sent directly to the auditor. So confirmation from the debtor. So it means that how to get this kind of information, you as the auditor, you ask the third party. So the information you get from the third party. Alright, the second, which is lower than that, so this is the external documentation, but this documentation is already have with the client. It means that you do not get directly from the third party, but is kept by the client. Right, such as supply invoices and bank statement. Right, why bank statement? Because this bank statement is actually prepared by the bank, is held by the or client or company that you audit. So this is the internally generated documentation. Alright, so circulated externally. So it means that documentation here, it means that you the client prepare, but this one is actually sent to the third party. Alright, receipt of deposit slip. Alright, so deposit slip, you receive the money and then you send that one to the client. And then for the shipping document, for example, they would like to ship 10 containers. So this one is prepared by the client company that we audit, but is going to be held by the third party. So which one is the least one? Is actually internally the client who prepared for the documentation, and the document is actually is going to be held or held by the company itself. For example, sales invoices, the duplicate of sales invoices. So who prepared? The client company. Who hold the invoice is also the client company, and also the purchase requisition. So this is the least reliable. Alright, now we move on to the other one. Test of type of audit test. So we have test of control, and then we have the substantive test. So what is the difference between the two? Alright, test of control is actually we are going to test on the internal control system of the company, whether is it effective, alright, effective policies, procedures of the company, or not effective. So the operating effectiveness of those policy, whether it's good or not good. Alright, if the system is good, so it means that you can rely on the system. If the system is not good, so it means that you cannot rely on the system. So what is the substantive test? So substantive test is actually you perform to obtain evidence about the validity and the appropriate of the accounting treatment. Okay, so here you are going to test on the transaction, right, and the balances, right, whether is transaction is follow the rules or not follow the rules. So test of transaction, we have two. Number one is test on the analytical procedures, and number two is test of the details. Alright, we are going to test the analysis, the procedures, analytical procedures, and also the balances. Alright, now we move on to the next one. So what is the analytical procedures? So analytical procedures is actually to study the comparison of relationship between the accounting data and the related information. Right? For example, you would like to see whether the information, the figures that you have in the company, and the information, for example, you would like to test on the ratios and everything. Is it considered is in the right track or not in the right track? Okay, so if the ratios for a certain company, for a service company, as I mentioned earlier, is not the profit ratios in the manufacturing company. The service company and also the restaurant is actually different. Alright, so here is also focus on the reasonableness of the relationship, and also to identify the unusual transaction for the investigation. So unusual transaction, we can see, for example, if the company is selling the school products, school uniforms and everything, so if the sales on December is increased, so that one is normal. Okay, even there is a unusual increase of sales or fluctuation, but it's actually it's normal for them, because the school holiday is going to end soon, and then it's going to have a new term of the school, so majority of the people would like to buy the school uniform. Alright, so we have three purposes here. Number one, to assist the audit planning and other audit procedures, alright, to assist them, alright, in planning. So for example, if the company is selling for the uniform, so it means that you're going to do more testing on the December. Alright, as a substantive test, to obtain evidence about the assertion, to make sure that we are going to test on the transaction, and then so this kind of transaction to make sure that you are confident with. And also the last one is actually you would like to know the overall review and the financial information near the end of the audit. So it means that here at the end of the audit period. So the one also is very important. Alright, now we move on to the second one, which is test of details. Alright, so as we can see before, alright, substantive test or substantive testing, we have two: analytical procedures and test of details. Alright, now analytical procedures already did. Now we move on to the test of details. So here, test of details is actually involve obtaining evidence on the item or details included in the account balance, class of transaction, or disclosure. So basically we have three over here. Number one, test of the detail balancer. So we would like to see in the GL accounts, alright, whether the account receivable already transferred in the correctly of the account balance. Alright, number two, test of transaction. Here, test processing of the individual transaction by inspecting the relevant document and accounting records. So it means that here we would like to see the transaction, whether the transaction is actually represent the real transaction or not. For example, here we have a sample on shipping document. So whether the document shipping to the third party or sent to the client, the third party or the customers of our client. So we have to trace to the sales journal whether it's actually included in sales or not included in a sales for our client. And the third one is test of disclosure. So it means that do they is actually disclose all the information in their financial reporting. For example, audit procedures performed to evaluate whether overall presentation of the financial report, including disclosures in accordance to a applicable account framework, reporting framework. So it means that here whether notes to the account that they already prepared here already disclose all those required that they're supposed to disclose. Alright, thank you.